Hello, and you're welcome to Global Business Insights, where we cover details on the main stories from the business perspective. BlackRock has done a deal with the Saudi Arabian government to set up a multi-class investment firm in Riyadh, anchored by a $5 billion mandate from the kingdom's Public Investment Fund. The goal is to attract additional overseas capital to Saudi Arabia and deepen its capital markets through a range of funds managed by BlackRock. Amazon, Microsoft, and Alphabet have all seen better than expected sales at their cloud computing units in recent days as interest in artificial intelligence helps spending by corporate customers. And some of the other earnings announcements we got yesterday. Eli Lilly raised full year forecasts by $2 billion on the back of a strong performance from its weight loss drug. Fast food giant McDonald's saw mixed first quarter results yesterday as restructuring costs weighed on profits, and Coca-Cola lifted its annual sales forecasts after first quarter numbers topped expectations. On the macro front, the Conference Board's Consumer Confidence Index fell. That's in the US for the third consecutive month to 97 in April from a downwardly revised 103.1 reading for March. And the S&P Case-Shiller's February Housing Price Index showed that home prices rose 6.4% year-on-year in February, the fastest rate of price growth since November 2022. And also in the US, another source of pressure on inflation came from the Employment Cost Index, which rose 1.2% in the first quarter. This reading followed the 0.9% increase recorded in the last quarter of 2023 and was above the market expectation of 1%. While in Europe, the Eurozone economy expanded in the 3 months to March of 2024, up 0.3% from no growth reported in the final quarter of 2023, also better than expectations for a 0.1% growth. And also in the Eurozone, the Harmonized Index of Consumer Prices, HICP, rose at an annual pace of 2.4% in April, the same as we saw in March. The market forecast was for a 2.4% increase. The core HICP, however, fell to 2.7% year-on-year in April as against March's 2.9% rise, but still higher than 2.6% expected. The much-awaited U.S. non-farm payrolls jobs data will come out on Friday. We also get Nigeria's April PMI coming out tomorrow. Today, the focus will be on the decision and narrative from the Federal Reserve, where interest rates are expected to be held constant later in the day at close of the two-day FOMC meeting. That's the Federal Open Markets Committee of the Federal Reserve Bank. We also discuss corporate ethics as Changpeng Zhao, that's the former head of the largest crypto exchange, Binance, becomes the second major crypto mogul to be sent to prison, joining Sam Bankman-Fried behind bars. You will recall that Binance has also been charged in Nigeria for tax evasion and other infractions. And we also dive deeper into Amazon's strong results, helped by its cloud business, and Huawei looking like it's having the last laugh when we see the rebound in their performance after struggling last year with US sanctions. And to Amazon, the world's largest online retailer, yesterday we saw results beating their earnings and revenue forecasts for Q1, helped by growth in both advertising and cloud computing. Earnings per share came in at 98 cents, over 83 cents expected on revenues of $143.3 billion, also ahead of $142.5 billion. Amazon Web Services, the cloud business, grew 17% with revenues at $25 billion, better than $24.5 billion expected, while advertising slightly outperformed expectations at $11.8 billion over $11.7 billion in revenues that was initially expected. For the second quarter, Amazon said it expects revenues of $144 billion to $149 billion, representing growth of 7% to 11% in Q2, slightly lower than analyst expectations to see growth of 12%. That's up to $150.1 billion. It was, however, a good start to the year. Notably, Amazon bucked a big tech trend of announcing a dividend. They didn't announce one, as rivals Alphabet and Meta platforms did. Dividend announcements from Alphabet and Meta platforms were chaired by investors who pushed the stock's prices higher. Amazon and Tesla are the only members of the so-called Magnificent Seven tech stocks that do not presently offer dividends. When you consider the ample cash flow, the timing looks overdue for Amazon to start paying its investors dividend. According to CEO Andy Jassy in a statement, he said the combination of companies renewing their infrastructure modernization efforts and the appeal of Amazon Web Services artificial intelligence capabilities is re-accelerating AWS's growth rate, now at a $100 billion annual revenue run rate. Indeed, we saw that rebound in sales growth pushed by AI in the cloud unit that investors were hoping to see, particularly after strong results in the same types of business as cloud of rivals Microsoft and Alphabet. Also, advertising revenues went up 24% to $11.8 billion, and that may have been helped by Amazon's introduction of video advertising to the Prime video streaming services. The stores business also continued to expand selection, provide everyday low prices, and accelerate delivery speed while lowering cost to serve. Amazon is also moving into emerging economies with plans to invest $26 billion in India by 2030. Amazon's shares gained about 4% in extended trading. The stock has jumped already about 15% in 2024. Yet another AI-driven success story. We will see when markets open if investors notice the slightly softer than expected guidance for Q2 and the fact that they're not getting the dividends like some of the other big tech companies are doing. Changpeng Zhao, known as CZ, the former chief executive of Binance, was sentenced yesterday to 4 months in prison after pleading guilty to violating U.S. laws against money laundering. This is the world's largest cryptocurrency exchange. Also, after Sam Bankman-Fried becomes the second major crypto boss to be sentenced to jail. Ethics and culture tends to be overlooked in much of business thinking these days, but the new normal presents a more alert regulator, and larger companies will become more vulnerable to scrutiny, especially when financial success in less regulated sectors begin to raise more red flags. Companies can no more be casual about ethics. They need deliberate structures and explicit value statements that makes clear what they can do or what they do not do. It's no more okay to say we are not breaking any law, but the litmus test has to be if regulators knew all about our operations, are there aspects they will be uncomfortable with? Ethics is not just about fair competition and prices in the market. It's also about treating employees fairly, having fair compensation practices, paying suppliers as due. It's also about doing it right, beyond doing the right things. Some major ethical scandals have drawn fresh attention to the theme of ethics. Carlos Ghosn went from corporate high flyer to zero in days. Sam Bankman-Fried, who was seen as the icon for the new smart young disruptor movement, was exposed as a crook and now CZ. Even when you try to pay attention to doing it right, there can be missteps that can prove fatal to businesses. Talk less of if you do not have any structures or formal ethical standards or processes in place. The best practice is to formally integrate ethics into every aspect of the company culture, both informally and formally, from recruitment, induction, and onboarding, ensuring ethics-related issues are well covered and values clearly outlined in the onboarding process. This means offering job-specific ethics training, providing role-specific ethical manuals, also making ethical conduct a regular part of performance reviews and human capital management, appropriately reinforcing and incentivizing ethical behavior. The C-suite must see ethics as absolutely key. The new young founder genius, not curbed by a strong ethical compass, can take off on a dangerous tangent. Standards should spell out zero tolerance for infractions like bribery, misrepresentation, money laundering and harassment, mistreatment of employees, cooking the books, mistreating suppliers and even customers, but also against taking advantage of loopholes in weaker regulatory environments, doing side deals with politicians, having policies on limits to contributions to political parties, and lobbying to push an agenda to influence decisions or approvals definitely should be no, and should be clearly articulated as things that the company will not do. Gifts should be capped. Accepting or making payments to directly or indirectly influence current or future decisions of government officials, definitely not. Most things done in an opaque manner that cannot be openly exposed may appear to help profits, but these things tend to come back to haunt your operations. In emerging economies, it can be tougher. There is a deceptive sense of an open, everything goes terrain, but regulators are getting much more vigilant. One hopes 4 months will teach CZ the lesson that needs to be learned. Huawei Technologies profits rose for the fourth consecutive quarter as the Chinese tech company moves to take more market share from Apple and other smartphone rivals. The company reported net profit of $2.7 billion in the March quarter, up 564%, the fastest revenue growth in 4 years, with a rebound in its consumer segment and income coming from new businesses like smart car components and accelerating its recovery from US sanctions. In sharp contrast, Apple's iPhone sales in China fell 19% during the March quarter. Huawei started selling its new top-of-the-line flagship handset, the high-end Pura 70 smartphone, and the response by Chinese consumers to last summer's surprise introduction of the Huawei Mate 60 series, powered by the first 5G-enabled chipset, also helped the surge seen in the quarter. Huawei may be having the last laugh, and Chinese products are definitely no more cheap and cheerful. Whether it's Tesla or now Apple, Asian giants are increasingly flexing market muscle and higher on quality while making fast headway on the latest technologies. And Wall Street stocks saw losses yesterday as market participants await the outcome of the Federal Reserve's two-day policy meeting and digested more mega-cap earnings. At close yesterday, the Dow Jones was down 1.49%, while the S&P 500 lost 1.57% and the Nasdaq Composite fell 2.04%. Investors are bracing for a hawkish slant, worried that Chairman Jerome Powell's post-meeting comments will respond to the latest run of hotter-than-expected inflation reports to reinforce current thinking of a fundamental shift from the two-rate cut scenario for 2024 that we saw in the latest dot plot. We could get more direct hints that rate cuts will still have to wait for the data to be more convincing. The Fed will, however, be somewhat reassured at the cooling of the US economy, but the focus remains on the inflation print. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.